Thank you for joining us for the Industry Insights session, Overcoming Market Uncertainty to Capture Effective Planning and Growth Opportunities. I'm Amy Lestitian-Burke, Vice President of Industry Solutions for the Consumer Brands Association. We're excited to bring you this series because it provides overviews of broad topics that are top of mind for CPG professionals. I have a couple housekeeping items before we get started. Everyone's line was muted upon entry, and that's really to reduce background noise. If you have a question during today's session, please share in the Q&A section of Zoom. We've saved time to answer your questions after the presentation. We will also share contact information for our speaker, and we encourage you to reach out to her directly after the session. All right, let's dive into the content. I am thrilled to be joined by Danielle Marceau, Principal Economist at Prevedere. Prevedere is a leader in external data and analytics software for predictive planning. And in this session, Danielle will discuss how to decipher today's market uncertainty and harness artificial intelligence and data-driven forecasting. She will share the U.S. economic outlook for the remainder of 2023 and into 2024, and take a deep dive into the current and future state of the CPG industry. Danielle, I'll turn it over to you to get started. Thank you so much.
Thank you, Amy. I'm excited to be here today and speaking with all of you. So let's jump right in here. Today, as we already, Amy said, we're going to talk about the current and the future state of the U.S. economy as a whole, and then do a little bit of a deep dive on consumer spending. And then we're going to do, really dive deeper into what all of this means, this macroeconomic climate, what that means for your business, and how you can actually start to apply this information to your forecasting and planning using what we at Prevedere call advanced predictive planning. So what a time to be an economist, right? There's a lot going on. So first, I just want to level set with you on where we are as far as the overall economy stands. Well, first and foremost, the economy has continued to really chug along through the first half of this year, surprising most economists and analysts out there. With, we saw the second quarter GDP showed some relatively strong growth. But if we take that high level, positive number and we break it down a little bit further, we can see that there are some very different dynamics at play within the overall economy. First, we have consumer spending. We've been hearing for a while now that the resiliency of the U.S. consumer is really what is continuing to just propel the economy forward. And that really still holds. Second quarter GDP showed that the consumer, they just continued to spend. Although the pace of spending, the rate of growth is slowing, and it's slowing pretty significantly when you look at real or inflation adjusted terms. And the other key trend that's going on there is what they're spending on, is still shifting, right? We're definitely seeing that post-pandemic shift towards services, towards experience over goods. And this is really clearly evident as we see that, when you look at some of the macroeconomic numbers, we see things like real retail sales. That is actually contracting year over year. When you look at inflation adjusted retail sales versus the same point in time last year, it's actually lower than it was last year. While real personal consumption expenditures, which the difference there is personal consumption expenditures includes more of like the service sector activity and service sector spending, that is very slowly but consistently, trending higher. What has really happened over the last year when it comes to consumer spending? And we'll dive into this quite a bit further here as we go through this presentation, but it's really twofold. First, the amount of pandemic era excess savings that consumers accumulated has largely lasted longer than many initially anticipated. And then along with that, even though consumers are worried about their current and future financial situations, at least relative to, the level of concern they had prior to the pandemic, they continue to deplete those savings at a pretty rapid pace, as well as turn to credit card debt in order to maintain that spend. And really, when we look at this from a consumer spending perspective, this determination to maintain their current level of spend, despite feeling uneasy about their financial situation, about the economy, it's really been the thing that has kept the economy afloat over the past few months. Now, that's just consumer spending. And again, we're going to dive into each of those pieces a little bit more detail later on. And consumer spending is important when we talk about the overall economy. Of course, it's important to your businesses and your industry. But thinking about it in terms of just overall economic output, consumer spending is about 2/3 of overall GDP. But all of the different parts of the different sectors of the economy are not as rosy as consumer spending. If we shift focus a little bit, let's talk a little bit about the housing market. We've all been hearing about the housing market over the past year since the Fed began to raise interest rates last March. There have been some significant headwinds, right? Home sales, home purchases, mortgage applications, housing starts have all been generally declining, through the majority of 2022, early 2023. And you can kind of see that from the middle chart here. But the initial shock of higher interest rates from, the Fed's raising interest rates does appear to start to be subsiding. So we're starting to see both prices and construction in the housing market begin to bottom out. Even while these higher mortgage rates persist, what's really becoming clear is that there is a significant imbalance between supply and demand within the housing market. There's simply not enough homes for people who want to purchase homes. And this is resulting in a bottom in building permits and housing starts. And so we're starting to see that drive up market prices again. So based on the fundamentals here, it appears that the initial shocks of higher interest rates on the housing market are now behind us, and recovery is underway within this industry, at least from a construction perspective. A new housing starts, although sales are muted, that's really simply due to the lack of supply, not having enough houses available for sale. So we're starting to see this bottoming out within the housing market, right? So personal consumption expenditures has continued to chug along. The housing and construction market was weak, but it's starting to bottom out. And then another large sector of the economy, what I want to talk about is the industrial side of the economy. Just because, while I know it's not directly related to your businesses, it still is an important factor when we're thinking about overall economic growth. And here at Prevedere, we like to look at U.S. industrial production, which is a gauge of mining, manufacturing, and utilities. When we take a look at this, we've been seeing weakness in manufacturing and other industrial components since late last year. We've actually been seeing contraction. Manufacturing through July is below year-ago levels. It is not a story of continued resiliency or robust economic growth when it comes to the overall industrial portion of the economy. We've now seen 6+ months of softness here. The good news is that the earliest leading indicators of manufacturing activity, so when we look at leading indicators, things like the ISM manufacturing purchasing managers index, they've reached cyclical lows, right? And so we're starting to see trends that are suggesting that while the manufacturing portion of the economy has been pretty weak, it may begin its recovery later this year, in the second half of this year. So when we take a look at this in aggregate, we see a lot of different trends going on, right? We see different sectors or different parts of the economy at very different phases of the business cycle, with consumer spending continuing to grow, even though that is significantly slower growth rates. The housing market is bottoming out. Manufacturing is contracting, but there's a potential bottom during the next 3 to 6 months. These are really different economies, depending upon the specific industry that you're looking at. And this is really unique, right? This uneven performance and varying business cycles across sectors it's a really unique dynamic at play. And so what does this mean for overall economic forecasts for the remainder of this year and next? Boiling it down, Prevedere's team of economists, we expect some headwinds in the second half of this year for overall GDP. We do not believe that we're at the beginning of a full economic recovery and that the economy will be off to the races. And we do not believe that the economy is going to be like off to the races in the second half of this year or this massive reacceleration. Things are going to get worse before they get better. Many economists have been calling for a formal and a technical recession where we have 2 consecutive quarters of GDP contraction late this year as consumer spending wanes. That includes, we were initially thinking that as well. However, as we're starting to see these unique dynamics of play, where all of these different sectors are sort of entering into their softness periods at different points in time, it's kind of shifted our expectations a little bit. So we expect softness in consumer spending in the second half of this year, with the biggest headwinds developing around the fourth quarter, when student loan repayments start again and coincide with near depletion of that excess savings that we've been talking about. We don't necessarily believe that these headwinds are guaranteed to result in 2 consecutive quarters of GDP contraction, therefore a formal technical recession, but rather what we're kind of referring to as a rolling recession. So when we think about the timing of the down cycles for all of these different industries, such as the ones we've already talked about, we might not actually see most sectors align in a 6-month period of contraction. As I sort of said before, housing construction is already bottoming out. Manufacturing bottom is likely to come in the next 3 to 6 months, while later down the road in the second half of this year, around the fourth quarter, we're going to start to see consumer spending crack. So this is likely to result in, maybe a quarter of GDP contraction and some significant headwinds, but it might not be enough to have 2 consecutive quarters in a row where we see other sectors, given the fact that we're going to see other sectors recovering at a period when consumer consumption is weak. And so this is what, here at Prevedere, this is our baseline scenario. So this is what is most likely and the most probable path that the U.S. economy is likely to take. So again, a little bit of softness later this year, with some contraction around the fourth quarter of this year, softness that extends into early 2024. But then we will start to see some economic recovery in the second, by mid-year 2024, we'll start to see things align a little bit more. And we'll talk through what are the drivers of that recovery next year later on as well. So now I want to show you a bit of a visual to highlight this sort of rolling recession, and then we'll dive into different sectors and talk about them a little bit more. This chart is showing the 3-period moving average of many different sectors compared to the same 3 months of the prior year. So it is a growth rate versus last year. This is looking at different sectors such as retail sales, inflation-adjusted retail sales, inflation-adjusted personal consumption expenditures on goods, services, housing starts, the S&P 500, manufacturing, business and capital expenditures, and overall real GDP. So these are all inflation-adjusted numbers. What I want you to pay attention to is that in past recessions, everything sort of aligned at one time. While yes, we definitely see certain sectors of the economy enter into downturns earlier than others. So in 2008, we saw the housing market enter sort of into that contraction first. Then we started to see some, the financial markets react, and then we saw it ripple its way through others. But those bottoms really sort of all coincided with this contraction happening at the same time. Of course, we saw a similar thing in 2020 with the pandemic because, well, it was the pandemic. Of course, everything happened at one time, but that's pretty common. What's interesting now is we're already starting to see many of these things bottom out, right? So the stock market, it has bottomed out and is in its way to recovery, at least so far, unless another downturn is coming, which I'm definitely not forecasting the market. I'm not saying, it's completely out of the woods, but from the numbers, what we're seeing is the bottom has already happened within the stock market. Real capital expenditures are nearing their bottom. Retail sales, on the other hand, are contracting. Consumption of goods has already sort of had its recession. It was contracting in the second half of last year. Growth in services is really slowing. Manufacturing is now declining year after year. We don't typically see such varying timings of these cycles, but they tend to be much more closely aligned, right? And so that's what results in a more defined and significant decline in overall or aggregate GDP. So we may not likely see all of these industry lows sort of culminate at the same time for that official recession. And so this is what we refer to here as a little bit of a rolling recession, where each of these sectors kind of experience their own business cycle and their own contraction at varying points in time, rather than all coinciding at the same time. So now I want to dive into a lot of these themes at play here a little bit more detail, and we'll really do a deep dive on consumer spending. So let's first start with inflation. I can't sit here and talk about the economy today without talking about inflation. Yeah, just like you can't read the news today without hearing or reading about inflation. So let's talk about it. The supply chain constraints of 2021 and 2022 have largely fallen off, and producer prices are easing, meaning supply side pressures that drove the really robust rates of inflation in 2021 and 2022 they ceased to be an issue in 2023. And we can see on the left-hand side here that global supply chain pressures, they spiked in 21 and 22, but they've now eased entirely. As a result of these non-existent supply chain pressures, we've seen a correction to global shipping and transportation costs, as well as commodity prices. Right? On the right-hand side here, you can see that global commodity prices have eased significantly from their highs. Again, this was the supply side pressures, where supply was not able to keep up with demand and was therefore pushing prices higher. So that's good news. The supply side pressures have really dissipated. But let's dive into what factors have continued to concern the Fed, right? Because now inflation is really driven by demand side pressures. And we'll talk about some of the things that are concerning to the Fed when it comes to inflationary pressures today, right? So as I said, demand side pressures have really taken over as the primary driver of inflation. This has been driven by strong, unexpectedly strong consumer spending and a really robust labor market, especially when it comes to the services side of the economy and other sticky price inflation. What you're looking at is headline inflation, or CPI. So that's what you hear about the most. But then we have that's sort of broken out into two separate buckets. So we have sticky prices and sticky price inflation. Sticky prices are things that are really slow to change and less impacted by commodity prices. So this is things like service sector inflation, housing or shelter price inflation. The other side, you have flexible inflation. So this is things that are much more impacted by things like commodity prices. So prices for things like food and energy costs. And as you can see from the chart, flexible inflation has already come down from its peak, and we're actually seeing deflationary pressures on the back of easing commodity prices and easing supply chain pressures. Sticky prices, on the other hand, are extremely elevated still. They have turned over as far as the rate of inflation goes. The rate of inflation is slowing a little bit, but it's still extremely high. This is due to the upward pressure that we're seeing on wages. Wages are the largest contributor to service sector inflation. Service sector inflation is still quite robust. Service sector is really dependent upon labor. And with wage pressure the way it is, we're seeing significant inflation remain within the service sector of the economy. At the same time, consumers are shifting their spending more towards services than goods. We can also see, A couple other trends here: housing or shelter prices, they are remaining elevated. As we will talk about a little bit here in a minute, this is really driven by supply constraints, right? So home prices, while there was a little bit of softening, they've already started to turn around again. There's still a little bit of a supply imbalance in the apartments, in both rentals and homes. So that's putting a lot of upward pressure on this sticky price inflation. And these sticky prices, this is what is most concerning to the Fed right now. We really need to get those sticky measures back toward more normal levels before we can say that the Fed has accomplished their goals and their objectives. And so that is one key thing. While headline is returning back towards levels that are preferable, when you decompose that a little bit more, the resurgence in the housing market and the impact that the shelter price inflation has on overall inflation is definitely concerning for the Fed. And this is likely to result in some additional, holding rates high for an extended period of time and potentially increasing rates again later this year. Now, we've already talked about the housing market. I'm just going to very, very briefly just kind of summarize, because this is such an important driver of inflation. When we look at housing supply and we look at prices, we see that demand is truly outpacing supply, even as mortgage rates cross above 7%. Now, when we look at the average 30-year fixed rate in the last couple of weeks, it's nearing 7.5%, which is really interesting because theoretically, when you increase interest rates, especially at the pace that the Fed has done during this hiking cycle, we would actually expect to see more balanced supply and demand because consumers face higher borrowing costs and then maybe they don't want to purchase a home, drop out of the buyer side. Now we're quite a bit into this rate hiking cycle, maybe even nearing the end of it. And instead of seeing a balanced supply and demand, we're actually still seeing things be a little bit off kilter. Demand continues to outstrip supply. One of the biggest reasons for this is that 99% of borrowers that have a mortgage today have a mortgage rate lower than 6%. Of those, 28% are locked in at rates that are below 3%, and 72% are at rates that are less than 4%. So there's not a lot of incentive. These homeowners are locked in at 4% interest rates in their existing homes, and interest rates in the market today are at 7.5% mortgage rate. So there's not a lot of incentive for homeowners to decide to sell their homes. They would rather sort of stay put until interest rates come down a little bit, because if they sell, then they're just going to have to get another mortgage at this significantly higher rate. And so that is really decimating supply within the housing market. And so when it comes to existing homes, there's not much supply out there because people don't want to sell. And because people don't want to sell, there's a low supply that's ultimately driving prices a little bit higher. But it is also spurring construction activity to try to meet that demand with new construction. So that is going to be a key that we're going to need to be paying attention to see how this resurgence in home prices ultimately plays out in that sticky price inflation that the Fed is continuing to battle to get the overall headline inflation level back down to where they would like it to be. So now that we've covered some high-level macro trends, I want to dive deeper into the sector of the economy that is most relevant to your business, and that is consumer spending. And when we talk about what drives consumer spending, I like to talk about three different pillars of consumer spending. These three pillars are employment. In order to spend, consumers have to have a job to make an income. The second pillar is income. Specifically income growth, right? So income has to be increasing faster than inflation, therefore increasing real spending power in order for consumers to spend. And third is confidence. Confidence that they will have that job and that income growth in the future. When we see all three of these pillars moving in a positive direction, we see really robust economic growth. and consumer spending. When they are moving in different directions, they're not all aligned. Consumer spending in the overall economy, they move a little bit more sideways, a little bit slower, a little bit more lackluster. And then when all three move in the negative direction, that's when there are many concerns and really point toward more of a full-on pullback in consumer spending or economic contraction. Think sort of the perfect storm. And we're going to review and dive into the current trends of each of these during the next few minutes. So let's start with the labor market. So everybody knows that the labor market is tight. It has been tight for a while now, but it is starting to show some signs of cooling, which is really great. And you can see here, labor flows appear to be normalizing with supply of and demand for workers entering and trending towards a more balanced state. That is good news when it comes to the tightness of the labor market. If you look at the left-hand chart here, this is the number of new hires every month. So new hires is slowing. It's slowing pretty significantly. And it's near the pre-pandemic levels. This is a good sign for a more balanced and more normalized labor market. We've also started to see initial jobless claims increase. They've increased back above the average over the most recent few years, and we are seeing a true sort of cyclical turning point there for initial jobless claims. And so while the labor market is still tight, I'm not saying that hey guys, you're no longer going to have problems filling your open jobs. I'm not saying that at all. It is still tight, but trends are definitely moving in the right direction. And we do expect to see some mild increases in the overall unemployment rate beginning really late this year. And that's going to extend into 2024. However, I want you to kind of keep this in perspective. The increased unemployment rate that we are expecting is going to be extremely mild relative to past periods of economic softness. So while it's going to tick up a little bit from its unprecedented lows where it's kind of holding today, that the amount that it's likely to increase, that the unemployment rate is likely to increase, is going to be pretty mild compared to past downturns. And I want you to just kind of keep that in mind and remember that because that's going to be a really important driver of economic recovery next year. And we'll talk about that a little bit more in a second. So now let's talk about the income pillar of consumer spending. Throughout the majority of 2021 and 2022, real or inflation-adjusted disposable income was actually contracting year over year, meaning that consumers' real spending power was actually just declining. However, at this point in time, spending was really propped up by the excess savings that was accumulated during the pandemic. You've all probably heard about this. You're probably all getting sick of hearing about it, but I do just want to kind of refresh what I mean. During the pandemic, there was excess savings that was built up from the fact that there was stimulus payments, there was other government benefits. At the same time, consumers were stuck in home. They couldn't really spend on services and travel and many things that they typically would. And so we saw this accumulation of savings. And that's what you see on the right-hand chart here. However, they've been spending it. And if you look at the real or inflation-adjusted amount of excess savings, they have been depleting it pretty quickly. And it's interesting because a lot of this savings is really concentrated in some of the higher two quartiles of income earners. Now, different reports say different things, but we're starting to see that some of the lowest income earners, we've actually seen this savings level be nearly depleted or depleted already. What we have been seeing happen for those consumers who no longer have this excess savings, many of those have been spending on credit, accumulating credit card debt. Credit card debt has skyrocketed over the last year back towards unprecedented levels. But with credit becoming more expensive and interest payments are increasing rapidly, that is definitely a bit of a concern. And we kind of shift to the next slide here, and we can talk about this a little bit more. Credit card interest rates are now at a record high level. We're also seeing credit card balances at a record high level as consumers really shift to spending on credit as they deplete that savings. As a result of this, something that we have seen is that the percent of disposable income that is being spent on interest payments, and I'd like to highlight that this is not including mortgage interest payments. This is just other forms of consumer debt interest payments. Think automobile loans, credit cards, etc. We're seeing the percent of interest payments of DPI be back to levels last seen during the Great Financial Crisis. At the same, consumers have really been racking up credit card debt. And what we're actually seeing is that credit card delinquencies have begun to accelerate as well over the last year. After, during the pandemic, they really fell to very low levels, but we are now well past the pre-COVID high when it comes to credit card delinquencies. So as this weighs more and more heavily on consumer wallets, we expect this to be one of the driving factors of a slowdown in consumer spending late this year. This is not sustainable. And as I showed you before, we are going to start to see that depletion of excess savings. Now, another curveball to throw into the mix that's likely to impact consumer finances around the same time is the student loan repayments that are going to be starting up again. As part of the government's pandemic relief program, interest hasn't been accruing and borrowers haven't been required to make payments on their federal student loans since March 2020. Now, those payments are set to resume in October. These payments can be pretty significant. It is estimated that the total of these payments is about $6.1 billion, and that equates to about 0.41% of total personal consumption expenditures. So thinking about that, right, consumer spending has been growing at a very minimal clip. It has not been robust. It has been pretty soft. So if we start to see this amount of dollars of discretionary spend being pulled from personal consumption expenditures, that can have a pretty significant impact on overall consumer spending and overall economic growth. So sort of the combination of these three things, despite the fact that wages are, they are increasing, people are not losing their jobs at a rapid pace at this point in time. But consumer finances really are starting to crack as those excess savings are depleted, credit card debt is skyrocketing, interest rates are extremely high, delinquencies are high, and then we're starting to add the student loan repayments. So these three things are going to kind of come together to be a pretty big headwind for the consumer's ability to spend next year. So let's shift 1 second here. So we got currently consumer spending is being upheld because the income portion is okay. The labor market portion is okay. What's interesting is the consumer confidence portion has not been that great, right? So they got the three pillars. Two of the pillars have been okay so far. Consumer sentiment or confidence has not been very high. And typically when sentiment has been this low, we're typically seeing economic contraction. But the employment pillar has remained strong and support for the income pillar has been temporarily propped up. So the lackluster confidence hasn't been that much of a drag. But as we start to see cracks in those other two pillars, the relatively low consumer confidence that we have been seeing will likely start to transpire into something a little bit more significant of a headwind. We're already starting to see consumers adopt a more budget-conscious mentality. They're shopping on price more than they were last year. They're doing more comparative shopping. They're trading down from higher price ticket items to more value type items. And we expect that trend to continue through the remainder of this year. So I've talked and kind of laid out to you some of the headwinds that we see coming this year, and really what to expect during the coming few quarters. However, as I stated before, we expect this contraction in consumer spending to be relatively short-lived. And we will start to see a little bit more robust economic recovery by mid-year next year. So I want to talk about what's going to be different next year. What's going to change and what are going to be some of the drivers of that growth that is to come after we get through this short-term blip later this year and in the first quarter of next year. And there's really three main factors within the economy that are going to spark this resurgence in growth next year. The first is going to be the stabilization of inflation. Expect inflation to continue trending towards the Fed target rate. It's going to be bumpy. It's not going to be linear. There's going to be some bumps in the road. It's not going to be, a super robust fall, but we do expect it to continue to trend towards the Fed's target interest rate, especially as consumer spending and overall demand cools later this year. The second is lower interest rates. With inflation trending in the right direction, the Fed's going to have the flexibility to lower interest rates in the second half of next year. Maybe even by mid-year, maybe even second quarter of next year. And that's going to help spur some economic growth into 2025. And then the third is the resiliency and the tightness in the labor market. Unemployment is going to increase, but it's going to remain relatively low compared to previous economic downturns. So this is going to help the recovery gain a really solid footing relatively quickly next year. Less jobs lost during the downturn means a more robust recovery on the upswing that's going to happen by mid-2024. So what does all of this mean in summary, right? So we are not completely out of the woods yet. Things are likely to get a little rockier in the second half of the year as higher cost of borrowing persists. Consumers are faced with some significant spending challenges. Unemployment is going to rise late this year and into 2024 in response to this pullback in consumer spending. But we're not likely to see a formal, 2 consecutive quarters of GDP contraction. And we're already starting to see, the bottom of the housing market form and likely a near-term end in sight to some of the manufacturing slump that's been going on. On the positive side, inflation is going to continue to trend toward the Fed's target rate as long as consumer spending cools as anticipated. It's going to be a little bit bumpy, but overall trend will be towards that. And I think the most positive thing is that we do expect things and sectors of the economy to be more aligned in recovery by mid-2024. So that was a lot to take in from an economic perspective, right? There's all of these different trends and all of these different themes going on in the overall economy. So the question is, what does this mean for your business? It's one thing to read about this information and to hear it, but how do you actually apply it to your business? What's the timing for you? Are you going to be impacted to the same extent as the overall economy? Are you in a niche industry, or are you in a geography where you'll be able to actually outperform? Will your core demographic of your core consumer be more or less impacted by all of these trends? So how do we actually take this information and make it meaningful? I really want to encourage you to answer these questions by adding advanced predictive planning to your current process. What is advanced predictive planning? In short, advanced predictive planning can help you bring an external perspective to your planning and forecasting to help you drive better decisions and smarter actions. So what is advanced predictive planning? What does this mean? In short, advanced predictive planning takes what you know about your business and it overlays the impacts of external forces by first identifying and determining which of all of these external forces will have an impact on your business specifically. Once we've done that identification, we then are able to quantify the impacts of these trends on your business. Once you actually have been able to quantify the impact of this economic and external environment on your business specifically, we then want to integrate that into your existing planning process, where you can layer in this sort of economic baseline forecast into your existing planning process. And then the last is you'll need to monitor this information in real time. Things are constantly changing, and the world around us is always evolving. And so we want to make sure that you're constantly monitoring these changes and how they're going to impact your business in real time. So throughout this process, businesses can be smarter and more confident in their forecasting and planning, whether that's demand planning, marketing, spend allocation, workforce planning, etc. So I have a few minutes left, and so I'm going to try to quickly, peel one more layer of this here and give you maybe a 20,000 foot view and give you a real world example of how this advanced predictive planning process comes to life. And I'll try to do this very quickly so we have time for questions as well. The foundation of predictive planning is data. Specifically, when we're talking about this type of planning, it's external data. Here at Prevedere, we have collected, aggregated, indexed, and prepared thousands of external data sources, which then contain millions of data sets for modeling purposes. So there are millions of external data sets readily available. But you can start this and do it yourself in a smaller degree by identifying key sources and pulling that data manually. Sources include macroeconomic data, industry-specific data, consumer behavior, global trade, weather, demographics, supply chain signals, things that are broken down by different geographies, global, or different geographies within a specific country, so regions or provinces. This data forms the basis and the starting point for your advanced predictive planning process. So let's start with an example company here. So this is a company, Home Goods, that could, let's think about this as a manufacturer or a retailer of home goods, right? So if you're in planning mode, first is we need to kind of figure out what is it that we're trying to plan for. So which layer or line of business. So in this example, let's create a external economic baseline, market validated prediction of total US patio furniture demand. And so what that looks like is you would take a single time series data set that looks at historical, this is US patio furniture sales. The next thing that we want to do is we want to then correlate this to all of this external data that you have gathered or is already pre-aggregated and find leading external indicators. So you're going to correlate this to industry-specific metrics, macroeconomic trends, consumer trends, et cetera. And what you're going to be able to do is find leading external factors. So in this example, we're able to see things like the Cass Freight Shipments Index is a 5-month leading indicator for US patio furniture sales. That's not the only correlated external factor. We've also found things like purchase intent and consumption and disposable income, many different correlated external factors. And so that is our discover and identify portion. The next thing that we want to do is you want to then quantify the impacts of these factors. Now you've got 20 to 40 different correlated external factors. Now build an econometric model. This can be a simple regression model. They don't have to be incredibly complex, but they can be built very quickly and at scale when you actually add some AI optimization to the econometric modeling process. But once you start to quantify the impact of these, now you can start to see, hey, when unemployment goes up, that is bad news for my business 2 months later. By quantifying that, we can say when I see an increase in the unemployment rate of 1 percentage point, that's going to negatively impact my business by 3 percentage points 2 months later. So you begin to actually quantify the impact of these factors through econometric models, specifically, the most simplest form, regression-based models. The next step is that we want to then integrate. You want to make sure that these insights, this quantification, and this information can then be integrated into your existing forecasting and planning process. Think about this both in the technology that you're using today and the processes that you guys implement within your organization. Whether that's integrated business planning and an S&OP process, this information that is this now unbiased external baseline should be a critical part of that sort of consensus forecast. This should be layered on top, and this should augment your current process. So it's not going to replace what you're doing today, but it's going to add an additional layer of external factors, of external information with this unbiased economic baseline to be part of your consensus forecasting process. And then the last piece is monitor. Once these indicators are identified and built, and then they're integrated into your process, we want to make sure that you consistently monitor them. Keeping a real-time pulse on these identified leading indicators and the world and the economy and the external environment as it changes is going to be critical. The process is a continuous loop, right? It's not a one-time research project. You want to make sure that you are continuously keeping a pulse on these trends and themes and how they directly impact your organization. So I think that you want to make sure that there is an automated process to help you do this. Something that can proactively alert you to exogenous shifts that are going on in the world around you that are going to impact your organization 3, 6, 9, maybe even 12 months in advance. So if you have this alerting in place after you have actually identified and quantified the impact of these, that's going to allow you to really pivot your plans and prepare for headwinds or take advantage of opportunities very quickly. So this approach of where we're actually combining the world's external data with an AI-powered modeling engine can really help business leaders to stay alert to the first signs of recovery or proactively plan for the first sign of a downturn. Can help you to really understand how your business specifically performs differently by region, by category, or understand the drivers of why your business is likely performing differently. And ultimately, it's going to help you better inform 2023 and 2024 guidance. Especially if we think about how volatile these economic times are right now, that's absolutely critical to make sure you truly have quantified the impact of these external trends on your organization. And so, many leading companies, just like yours, are utilizing advanced predictive planning in some way. And a few examples are, Kraft Heinz is using this process for each of their major food platforms to identify which economic drivers impact their business. Looking at total category as a starting point and truly being able to identify and quantify the impact of things like reduction in SNAP benefits, the declining savings, excess savings, the elevated unemployment that's expected next year, to truly be able to quantify those impacts. So I know I went through that very quickly because I really wanted to show you that real life example, but I know we're really getting close on time and I want to make sure that we have adequate time for questions. So at this point, I think we can probably open it up and try to address some of the questions that you all have asked throughout this presentation.
Yeah, thank you so much, Danielle. As Danielle just said, we are in the Q&A portion, so please put your questions in that Q&A section at the bottom. And Danielle, we did have some come in throughout. It was packed full of information, and this first person says, thank you so much. I think maybe they're a little overwhelmed. But their question is, they'd like to translate this to the CEO. So what are one or two things after hearing this that they should bring to the CEO and kind of start that conversation about what's coming?
Great question. So I think the three most salient points would be, despite the positivity we're seeing in the headlines, we're not out of the woods yet. So expect for a bumpy and rocky second half of this year. Don't get linear in your expectation. Don't get overly confident. We're in for a rocky second half of this year, but it's going to be short. The second point would be that it's going to be short-lived, and we will see a more pronounced recovery take hold next year. And then I think the third point that is most, salient for you guys with, that's listening in today is what the consumer is going to be spending on. So just keep in mind that during that rocky point in time, consumers are going to be more budget conscious. They're going to look to trade down. They're going to be looking for value opportunities. So I think that that's going to be really important for strategy in the second half of this year.
Okay. Yeah, that's great. Not to get, I think the media, sometimes you think that might be reality. So it's good to hear what you're saying here. Another question that came in is, when do you think the Fed will begin to lower interest rates again? Any crystal ball on that one?
Yeah. So they've made it very, very clear that they are going to hold rates pretty high for a pretty long time. I would not expect any lowering of interest rates before at earliest second quarter of next year, but probably the second half of next year. Even as the consumer starts to wane and we start to see some of these bumps in the road that I've been talking about, that's what they're aiming for. That's their goal, right? So they're going to kind of let us feel a little bit of pain to really make sure that they squash out inflation. We do not want a repeat of the 80s. What happened back in the 70s, 80s, the economy started to falter a little bit and they dropped interest rates too soon, sparking and spurring demand again. And then we saw a reacceleration in inflation. So that is the last thing. They have learned from the past, and they're going to make sure that they absolutely do not allow a second resurgence in inflation. And therefore, they're going to keep rates high even when we start to feel a little bit of pain. So mid-year next year at the earliest.
Okay. Another question here related to the headwinds. So how will impending headwinds for consumer spending impact this year's holiday shopping season?
Yeah. So when I talk about the holiday shopping season, it depends what part, who we're talking to, right? Because there's a very different, in the street, they care about revenue. They care about dollars. They care about sales dollars. And inflation plays a big part in sales dollars. Others care about volume. And so I think what I want to kind of parse out here is, when we look at holiday shopping, we look at spending in the fourth quarter of this year by consumers on an inflation adjusted basis. So real spending, expect there to be a bit of a contraction from the third to the fourth quarter. So some significant headwinds. Now, when you let that be in terms of sales dollars, because of the inflationary pressures that have been here, I bet there's sales dollars are going to be a record high dollars spent this holiday shopping season, right? So you're going to have this sort of, two sides of the story, because consumers are going to be buying less, but they're going to be spending more dollars to buy less. So it depends what you care more about and who you're talking to, which side of the coin that means.
Yeah.
And as far as the economy, and GDP, right, that's all measured in inflation adjusted, right? So as far as will we be in recession, will we not, like, that is real inflation adjusted dollars. So that's really impactful, to how it ripples through the rest of the economy.
Yeah. Yeah. So you talked about the predictive analysis, and there's a question here like, how do you take this to action? Like, what's the first step that they should do to start this, right? Like you talked about the data and all of that. So what should they do out there if they're like, yes, we need to do this?
Yeah, I think the first thing is decide, are you going to try to do this yourself? Are you going to try to do this with some support? So I would definitely recommend, of course, feel free to reach out to Prevedere if you want a little bit of help. But if you're going to do this yourself, it is not impossible to do yourself. We bite off little chunks here. So the first step in do it yourself is going to be go find a reputable data source. There's a lot out there. For somebody just starting out, I highly recommend the Federal Reserve Board of St. Louis. It's referred to as FRED. That's a great source for data. So start with your data, go to that website and start grabbing some of that data that seems relevant to your business. So that would be where I would say to start.
All right. Well, thank you. We are close to time, so I want to say thank you, Danielle. Thank you, Prevedere. We certainly appreciate your time and energy that it took today to share your insights and intelligence with us, and certainly to Prevedere for their continued support of consumer brands and the consumer packaged goods industry. I'd like to thank everyone who attended, and we look forward to seeing you again soon. Thank you so much.